Welcome, everybody, to the Real Dealz podcast, one of the top-ranked real estate investing podcasts for the last 7 years. This is the place to be for investing strategies you can actually use, expert interviews, and, of course, some good old-fashioned entertainment. Now, here's your host for the show, Elliot, the REI guy, Smith.
What's going on, Real Dealz podcast listeners? Coming at you with show 402. All right, guys. So today is going to be a solo show, and I actually have a lot of really good things to talk about. I'll get into my stuff here in a minute, but I'm going to go over mortgage rates because that's big news right now. Fastest increase in mortgage interest rates in 27 years. Hedge funds. I'm going to go over some hedge fund stuff. I have some great articles. And what I'm going to be doing today is I'm actually going to be going over headline articles that I've been reading and just pull out a few things and give some of my thoughts, opinions, and maybe get you to start thinking as well about what's going on in the market. And then I'm going to talk about inflation and just kind of maybe give you some ways to protect yourself and just some ways that I'm thinking. But I would also love you to reach back out and tell me what you're thinking. Love to have opposing views. The mainstream media is saying one thing all the time, but usually what we've seen before is it's a black swan event that crashes the market that you weren't expecting to have happen. So anyway, what's going on with me this week? So we just closed 2 weeks ago, last Monday, on our 31 unit over in Richland, 31 unit with a lot, and we paid $3.2 million. Pretty excited. It had 19 units that had tenants in it. We gave notice to every single one of them. We're doing a $2 million rehab. And this is going to be an A-plus area with an A-plus property. These units are huge. They don't make them like this anymore. The 3 bedrooms are 1,350 square feet. The 2 bedrooms are 1,050. The 1 bedrooms are still 900 square feet, which is so big in today's market. So really excited about that. Chrissy is taking on that project as well. We have so much going on. So we actually decided to kind of take the next 6 months off. And not off of work, but from buying things in the multifamily space, unless it's in the same area of the properties that we currently have, or it's just something too good of a deal to pass up. Everything else, we will just kind of wholesale those properties. And it actually works out really good with me. So as you've been listening along, I've been struggling a little bit on some mental health side a little bit. Haven't really been into it. Haven't been as consistent as I would like to be. And I can put it this way in a lot of sense. I had somebody tell me a couple weeks ago, man, you're really successful and you're just really doing a good job. And I thought about it. I'm like, yeah, in business I am. We could not work. We could stop working right now and be done for the rest of our lives and have a good life. We have set ourselves up very well. But what I neglected was Elliot and Chrissy and now Monty. I neglected those things that actually matter in the long run of actually getting to know myself and understanding that there's something different in life than just working all the time or thinking about work or whatever. So after I went to rehab at 21 and I started working for Franz, I was working 60, 70 hours a week. And as I was going up the corporate ladder, I was going in on my days off just to learn. And I put everything I had into that. When Chrissy and I moved back to Tri-Cities, I started golfing, and that's all I did was just golf and worked a couple hours, 10 hours a week, flipping houses. When we started the call center and everything else, in 2020, that's all I focused on was just those things. So trying to find some balance, and I'm actually going to be kind of Mr. Mom for the last roughly 2 weeks. I've been getting Monty up in the morning. Well, when he wakes up, he comes in my room, we snuggle, and then I take him to daycare at my mom's. And then I've been picking him up and I'm doing the laundry. First time I've done everybody's laundry, I put it all away, cleaning the house, helping around the house because Chrissy is so much better suited for where we're at with the multifamily deals at this moment in time. She's actually running the company. They just hired a superintendent. We have property management. We have maintenance. We just gave her a very generous salary to compensate her for her time because she's earned it. And so she's doing all those things, and she's just better at those things. I'm have one project here in Tri-Cities that I'm supposed to be managing the rehab because she doesn't have time. And now I know why I shouldn't be managing them, because I just forget about things, or I'm like, oh, I'll do it tomorrow. There's no carrot there for me to do the rehabs. It's just not my deal. And that's why I'm a good sales guy, right? When I'm up and I'm down and I'm up and I'm down, and when I need to be on, I can be on and I can turn it on and be charming and go get that deal and just go pedal to the metal. It's when it's got to be consistent, kind of more like the tortoise and the hare, right? The tortoise wins because he's just consistent, but I'm the hare because I'm fast, go. So she's running all that stuff. So she was just really stressed because she wasn't having time to work out. She wasn't having time to actually be a mom. And so I'm just like, shoot, you've kind of played in the background and helped us be successful since we started this 6 years ago. I think it's my turn to maybe be in the background a little bit and help you be successful, because she is doing very, very good. Our partner, Greg Lynch, he runs a huge company over in Kirkland. They have almost 20 employees now. So he's seen what it takes to run these kind of teams, the superintendents and the people. And he's kind of coaching her every couple of weeks, but he's said she's very good, and the salary reflects that too. So I don't know. I think that's a good thing. So let me know your thoughts on that. I think it's in this day and age, it's kind of not always the easiest thing to do, but I think right now it's a good thing to do. So anyway, that's what's going on with us. Let's jump into this. Here's a quick word from our sponsor, and we'll get back to it.
All right, Real Dealz podcast listeners, I want to talk quickly about our show's sponsor, Ironbridge Lending. If you guys have not reached out to Ironbridge already to talk to them about funding some of your upcoming flip projects, I highly encourage you to do so. I've known the owner of Ironbridge for a very long time. I've personally borrowed millions of dollars from them over the years to do a number of different projects, and I can say without a doubt, they are the best hard money lending company I have ever come across, and that is the reason why they are the sole sponsor of this show. I've had a lot of other companies reach out to me and want to sponsor this show, but I just won't do it. I feel like I need to be genuine in who we have sponsoring the show, and it needs to be somebody that I've personally done a ton of business with. So I personally vouch for their ability to be the best, hands down, in the world of hard money lending. You won't find better programs, you won't find better terms, and they're lending or will be lending in over 20 states. So chances are, if you're hearing this in whatever state you're in, it's definitely worth it to check out their website, reach out to them, see if they're lending in your state, and if they are, I would absolutely encourage you to do business with them. Another very cool thing to note is that they have a program for most rehabs where you can actually borrow up to 90% of the purchase price. Now, this is given the fact that you are actually buying a deal, which if you're listening to the show, that means you probably are. But if you have an actual deal on the table, they'll fund up to 90% of your purchase price, and they'll even give you rehab funds on top of that, which means that it only takes 10% down to get into a project, which is unbelievable in the hard money world. So do yourself a favor, reach out to Ironbridge Lending, have a conversation with them, see if they're a good fit for you and for your next project. I can guarantee you that you'll be happy that you did.
All right, guys. So this week, the show is going to be titled Mortgages, Hedge Funds, Inflation, What the F? So let's start with mortgage rates. So I pulled some articles here. First one's over on CoStar. And so it says rising mortgage rates are causing more home sellers to lower their asking price. This came out today. So it says about 12% of home sales had a price drop during the 4 weeks of ending April 3rd. That's up from 9% a year ago, according to Redfin. So the number of listings also jumped 8% from year to year. What does that matter? Well, that matters because that's what happens. Supply and demand, right? We've been in a supply and demand crunch. Mortgages were so cheap. There was lack of supply. People were refining. There wasn't enough new homes. There wasn't enough inventory. So prices went up, mortgage rates stayed down. And the reason the mortgage rates stayed down, which I've been talking about for quite a while, is because the Fed was buying a third of all mortgage-backed securities every single month. So think about it. I think it's a $1.5 trillion market annually for mortgages. The Fed was buying $500 billion of that. So basically almost $50 billion a month of mortgage-backed securities, where the Fed does not have a directive to make money. Their directive is to stabilize the economy. The Fed is actually not part of the government. It was created by banks, for banks, to protect banks. That's what it's for, is to keep our monetary policy so we weren't having huge busts and booms. So the Fed was instituted in 1913. There's actually a really good book on it called The Creature from Jekyll Isle that talks about how it was instituted. Basically, these bankers and some senators got into a train car on Jekyll Island, didn't want anybody to know, and then they put this Federal Reserve together. They named it the Federal Reserve, so people thought it was part of the federal government. Now, the chairman, Jerome Powell, this case, is appointed by the president. They give updates to Congress, but they don't answer to those people. Those guys don't have any say in what they do. The Fed has the Fed chairman, and then they have the different branches of the Fed. There's 13 different branches, and then they have monthly meetings, and there's heads of each one of those branches. So there's like a West Coast branch, there's the one in Dallas. So there's all these regional Feds, and they vote on the monetary policy, and they're the ones that enact monetary policy. And so what that means is they don't want a recession, but they also don't want the market to be too hot either. So where they screwed up is they have inflation going through the roof. They waited too long to raise interest rates. This whole COVID thing, it's not all their fault, just screwed us. And also they had weak monetary policy. The economy couldn't handle, higher interest rates through the whole 2010s, right? In 2018, they got the Fed funds rate to 2.5%, 3%. Mortgage rates hit briefly like 5.25%, and the real estate market basically tanked, and the economy couldn't handle it. And so Trump's like, you need to lower interest rates, which it was the greatest economy of all time, right? But they couldn't handle those high interest rates. So the Fed has, we've been addicted to easy, cheap money since we had the Great Recession in 2008. And the Fed's toolbox is getting limited and more limited every single day. And they have to break the system. In my opinion, the only way is they just slam high interest rates. They break the system. They have to force us into a recession. And that's what they're talking about, because we cannot sustain this high of inflation. Where inflation's good is owning assets. So if you own a house, if you own rental properties, if you own apartments, then you are in a very good position, because inflation makes those appear to be worth more money. Technically, it's not really worth more money. It is in the size, the amount of money you have. But then when you go to buy something with that money, that stuff's more expensive as well. So, but that should maintain with inflation. Now, housing, apartments, they jumped up 20, 30% in a lot of markets. That's abnormal. It should correct the mean. Not saying it's going to decrease, but it should correct over time. And so also taking into consideration what the inflation rate was. So really, if real estate went up 20% and inflation was 7%, which actually by a lot of counts, it's actually more than 7% because they changed the way they tracked inflation. Of course they did, because they didn't want to have bad numbers. But let's say it's 10%. Well, then that house really only truly increased 10%. So that's how you have to kind of look at those things. So that's why in 2020, the smartest thing I did is I told Chris we need to buy more rentals. But then what happened is we kind of got lucky, got the first apartment, and then we had another one fall in our lap. Like, I'm no genius in a lot of these things. Like, I really did get lucky on some of these apartments. The last one we closed, I did not get lucky. That was planned, searched, and that was a very good deal. And that was from our marketing and our efforts. But getting lucky is great, but I also put myself in a position to be able to get lucky. So if you're out there doing things every single day, like I've said, driving for dollars, doing all these things, yeah, you'll get some properties, and you might, man, that was lucky. It came from somewhere totally out of left field, but you were putting the work in other places. And so that's kind of how the world works. Things fall in your lap. So it knew that we were looking for more multifamily. We were putting the work in. Multifamily fell in our lap. So interest rates are pushing 5%. A lot of, for some people, they're over 5% right now. The concern is affordability. So I'm very concerned. We own one property that's kind of a middle house. So it's not an entry level. It's more of a step up house. And it's in a decent neighborhood. When we bought it in December, January 1st, I'm like, oh, this thing sells for $475 to $500 all day. Well, yes, in that market it does. I didn't expect in 3 months that interest rates would be up almost 150 basis points. So that changes things, because it's not in an A+ area. It's not going to be it's 500, 475, 500. Yes, it's really big, but you can also go buy new construction in our market for entry-level new construction for that price or under that. So that's where it starts getting nervous. I really would want to have right now entry-level housing. Now, to speak to that, we had 2 flips that we just listed in the last 2 weeks. Flip 1, C neighborhood, C minus neighborhood, starter neighborhood, cute little house, kind of janky, had a garage that was kind of addition. It was an older house from the 50s that had been added on a couple of times. Is basically what it was. We did a good job, made it look good, but it still didn't flow great. But we priced it under $300,000. We priced it at $280,000. We ended up going pending over $300,000 because there was literally 4 houses on the market for under that price point, and people were trying to rush. Okay, my 475 to 500 house, there's a lot of houses on the market in that price point. That's the median. That's the middle of the market. So, okay, we're gonna have a lot more competition. Now, we had another house in Richland, which is an older, again, 1940s house, smaller, 775 square feet. They call them the prefabs. They were built during World War II when Hanford was doing the nuclear stuff for the nuclear bombs. And done really cute, really nice house, but it's still small. And we own a couple of those as rentals. Never in a million years would I say that one of these properties would sell for $290 in the 290s. Even on my net worth sheet that I just update like a month ago, I have like 245 on my ones that I own that look just like this. But we literally listed that for 279, got bid up again, multiple offers. So we're pending with some very good buyers, very well qualified buyers. So those type of projects are good in this kind of environment. So you need to understand, what are you focusing on? Things are going to happen. As this headline says, the new listings jumped 8% from a year ago. Again, this is nationwide. And the home sales, 12% of home sales had a price drop during the 4 weeks ending in April 3rd. That's up 9%. And so what does that tell you? That tells you that more people are like, oh shit, I need to sell my house because we're at the top of the market. And more people are like, oh shit, I need to sell my house, so let's drop the price because we're at the top of the market. I don't want to be stuck. Here's where the issue is. One thing everybody keeps saying is supply, supply, supply. There's not enough supply. Okay, I can buy that. If you follow Ivy Zellman, she can actually give you a pretty good counterpoint to why that's not really the case. And I'm somewhere in the middle. At first, I was always touting that, oh, we're short 5 million homes, 5 million homes. Yeah, I don't think so. I don't think we're that short. I think we're short homes in certain markets. Tri-Cities, we're definitely short, but we also have a lot of economic driving factors here. Austin, Texas, they have the new Tesla thing. Florida. Yes, there's certain markets that are going to be way short, but there's other markets that are not going to be way short. Then you have materials rising, prices rising. So even shorter, you have materials that you can't get for 6 months. So it takes them longer to build the houses. Here's the issue. Lumber dropped from 1,300 a board foot to 1,000. It's under 1,000. So that's starting to drop down. They have lumber. They're sitting on it. They just don't want to push it out. Oil prices, I saw the other thing just last night, they dropped under $100 a barrel. Gas prices aren't going down, well, because people are paying it. So I think we're in a new normal in a lot of this stuff. However, if you look at this, I think I don't remember, I couldn't find the exact stat. I looked for like 20 minutes, so forgive me if I'm wrong, but I think something like 60% of all mortgages in the US right now have a rate that's below 4%. So where I don't think the market's going to crash is because if you have an interest rate, I have a lot of rentals that are like 2.75%, 3%, right? Why would I sell those or refinance those right now unless I absolutely had to? I wouldn't, right? Because, okay, why would I sell a 2.75 or a 3% interest rate and then go get an interest rate at 5.25? That would be stupid, right? My rate and payment's going to be so much higher. People are not going to sell their house because they can't get anything better. The reason you sell your house for most people, one or two reasons. One, your family's growing, you bought your first house and you want to get a bigger house because you want more yard, you have kids, you want to have more space, right? That's why we're in the house we're in. We had a 1,000 square foot house. Last couple years ago, my wife wanted a bigger house, so we moved to a bigger house. And it's still probably not big enough. Or you're getting older and you're downsizing. So then you're going to sell your house and you're going to downsize, which is probably in that starter home market. One of those two houses that we're selling is an older person that was downsizing. Okay, so that gives you inventory, but that's a 1-to-1. The only other time you get new inventory from home builders or people die, right? Or they sell their rentals or second homes or whatever it is. Rentals will probably be the more sense because second homes, people aren't really going to sell those and they're not really going to fit that part of the market for the most part. But let's just say that that's where it's coming from. But as I stated earlier, why would I sell my rental, right? Rents are rising extremely fast. Best time ever, unless you're in a liberal state for the most part, but you can still navigate that. And where else am I going to put the money? You know, I'm not going to get any return on it in the bank. They still, even though interest rates are higher, I'm still not making any money there. So that's going to limit the supply of inventory. People are not going to sell their house with a 3% mortgage to go spend more, get a more expensive house because inflation's ran it up, and at a 5% mortgage because they can't afford it or it just doesn't make any sense. Like most people wouldn't do that unless you just have a ton of disposable income or you're just making so much money it makes, you know, that you just need a bigger house and it's like, oh, whatever, it's not going to impact me because it's only 30% of my monthly income. So that's where we're at there. But what that's going to do is this going to kind of, I think, in my opinion, I think it's going to stall everything out. I think the people that are trying to first-time home buyers or they're just getting into the market, so people my age, they're talking about buying homes, they're going to just say, you know what, I think we're at the top of the market, interest rates are too high, interest rates price them out, they're going to stay at their rental or doing whatever they're doing. I think that's going to stall them. It's going to stall the people that are in that starter house to buy a step-up home because that's really expensive. Maybe they have a good location already. They'll just deal with it, but they don't want to spend that much money or they can't afford it because of interest rates and housing prices. Older people, what are they going to do? Unless they're going into a retirement center, you know, like my grandma. My grandma's 91. She has dementia. It's actually been getting really, really bad really quickly, and it's actually been a challenging week. This year, if I can tell you one thing, you know, I've been talking about mental health and all that stuff and some of the challenges. Like this year, the hits just keep on coming. So it's been challenging because I take care of her finances. My son is named after her late husband that passed in 2010. So she's going downhill fast. But when I'm pricing out some of these homes for her to go into, she has enough money to cover a decent amount of years, but she doesn't have a ton of money. But you start pricing out some of these places, some of these things are $12,000. I mean, it's ridiculous. The reason why, you know, my cousin was here yesterday and they have, their mom is in a home. She got fully paralyzed. And so, but she has Medicaid paying for stuff, which is a freaking joke in itself. But she's at this place that's super nice, paying $12,000 a month. And you ask yourself, how is that possible? It's because the government's paying for it. It's the same thing with colleges. The government backs the loans. It's just same with the hospitals and healthcare. It's just all screwed up because the government's backing things or whatever. So if she's going to pay for it out of her pocket because she doesn't qualify for Medicaid, well, can she afford that? Like, what's a memory care center cost? So I would rather just hire somebody to come into her house. So again, right there, I am not going to put her house on the market to then go put her someplace in a home because it's so expensive, right? And she only has so much money. So that's where I think we're going to see a stall out. But I'm nervous in a lot of ways because we have the 3 properties. We're refinancing one right now that luckily we got a lock in on a 24 unit. But we have the other 3 multifamilies. We were planning on refinancing the 25 unit because the value is probably, we bought it for 2.1. It's probably worth 4 right now. So we could probably pull $1.5 million out of that deal. But we started talking to the guy back in December because we kind of saw this coming. But now I have to wait till May, and what a rate's going to be at May. Now it might not make sense, so I might have to lock money in there and not be able to get access to that capital. Then we have these other 2 properties that are on bridge loans. Luckily, they're on fixed rate 5-year bridge loans. Even after the construction's over, they're on fixed rate. One's at 3. The first one from November is at 3.75. The second one is 4%. But that's the one we just closed last week. We have another 16 units under contract that we're supposed to close on in 60 days. What's that rate going to be at? Because that's a decent deal, but the only reason we are buying it is because it's on the same exact street of this other one we bought last week. So it gives us some scale. And it's a good asset. It'll be a good asset to have. But what's that going to be at? Now, we underwrote all our properties at a 6% interest, as like worst case scenario. I just didn't think we would be getting to 6% this quickly. So that's kind of some of the concerns I have. That's another good reason to kind of tap the brakes for 6 months. If you have the ability, I would really try to tighten up your buy box right now and really make sure you're spending some time focusing on like, what is my buy box? Let's get your pencil really sharp. Let's make sure you understand your costs and make sure you're putting extra money on there for your costs because inflation's going crazy. Construction costs are going really high. Your timelines are going longer because you can't get materials, and prices might stall out. Do not bake in appreciation right now. I think you're safe to say, okay, I'm pretty confident today it sells for this price. I think you're pretty safe to stay there, but you might also have the property set on the market for a couple more weeks or a couple more months. So price that stuff in. Make sure you can handle it because this is where you can really get sunk. So, all right, that's that. All right, hedge funds. So the hedge fund game is a very, very interesting deal. There is a lot of hedge funds. Everybody's heard of Open Door. Zillow got crushed, as we all know. They thought they could figure it out with their algorithm. Obviously, they couldn't. So, but you got Open Door, you got Blackstone, you got Invitation Homes, you have American Homes for Rent. All these guys are raising buku amounts of money, just tons of money to go buy single-family homes. Tucker and I talked to a guy last year for our call center. We were actually asking him about what is your thoughts. They're telling us all this, and we couldn't believe it. But Tucker's like, how does this end? This has to end poorly. And the guy said, it doesn't because we amortize them over 30 years and we sell them as a REIT. So you're basically pushing the stuff off to guys like mom and pop investors that have this in their retirement accounts and their insurance accounts or whatever. So they're just going to push the can down the road. They all know, and they saw this very clearly, what happened in 2008, 2009, 2010. What did the government do? The government bailed them out. The government bailed every single person out. Without fail, that's what they'll do. So you really have to look at this stuff and say, they don't care. They know that they're raising money from mom and pop, or they're raising money from big insurance companies. They're raising money from school pension funds, all this stuff. But at the end of the day, the person that's going to get screwed is not the hedge fund. It's the pension funds. That's the people that are going to get hurt. So here's what the guy told us as they were buying homes. They had Singapore was putting $2 billion. These are like other countries are coming in here. $2 billion to go buy $2 billion worth of homes. So let's call it 5,000 properties. They go buy these homes over 24 months. And they have their own cash. So they use their own cash to do this. Then they go to the Federal Reserve basically kind of bank rates. Not the Fed, but they get very good rates we'll never see. And they basically pay like a point over LIBOR, right? Half a point. And so they get rates that are way cheaper. So they refinance that $2 billion worth of homes out for $7 billion. So they take that and then they go sell it on the market as a REIT. They go sell it as a REIT for $11 billion. And after their fees and other costs, they pocket $3 billion. Well, pretty good game. But again, who gets left holding the bag, right? These are the guys that are paying over ass. They're driving housing prices up. Now, everybody says, all these hedge funds are screwing everybody. And these big investors are screwing all these markets. They're doing this. They only own 2% of the rentals in this country. Mom and pop investors like myself or older landlords still own the majority of rentals, but these guys are moving very quickly. So here's there's an article that basically says single family rental deals fill CMBS loans. That's commercial mortgage-backed securities. Lol. Because nobody's doing loans right now for commercial loans because rates went up. So it's very interesting to read these articles. But they basically said 6 separate single-family CMBS offerings have been launched. This is March 31st, and this was this year, with deals coming from Blackstone Group, backed by Home Partners of America, Starwood Capital Group, Tricon Residential, and First Key Homes. Progress Residential has made its third offering of the year after pricing another just weeks ago, according to the U.S. Securities and Exchange Commission. The single-family rental sector continues to expand. Bank of America Securities in March estimated that over $50 billion has been invested in the sector by institutions since the start of 2020. $50 billion. There remains a significant room for growth with current institutional ownership of single-family rentals estimated to be less than 2%. That's That's what I was saying, only 2%. Single family rent growth was up 12% year over year. The other thing this guy said to us was the other reason they're not concerned is COVID was the perfect time for people to not pay their rent, not pay their mortgage. They had forbearances, all these things. They had no excuses because nobody could kick them out. So they only saw a 3% decrease of receiving rents across the board. So in the most perfect time, people were honest enough to pay their rent. Only 3% of people couldn't pay it. So that's like got to be the greatest asset of all time. It's just consistent, right? So that's amazing. So pre-sale deal analysis are out on 2 of the upcoming offerings. Tricon Residential 2022 SFR 1 and Home Partners of America 2022 1. Both are the first offerings of the year for each firm. Tricon 2022 is to be $579 million, offering backed by 2,400 single-family homes being rated by no bond agency. So basically what this is saying is they're going out there and they're buying all these homes. Just like in 2008 when they packaged up all these mortgages. They packaged them all up. They go give all these mortgages. Your local broker would sell the mortgage. They'd sell it. They'd package them up, and then they'd sell them to investors, right, for a return. And so that's what these guys are doing. They bought 2,484 single-family homes. They have a bond agency rate this, so they're basically selling a bond, and it's backed by these 2,400 homes. And then they're basically doing a cash-out refi. That's how they make their money. So that's what they're doing right now is they're packaging these up and then selling them as a bond. And then the people that are buying the bonds says Blackstone, but they're actually investing money for New York Life Insurance, Chicago's pension fund, all these different funds. And so here's an example of that. So Toronto-based Tricon, along with joint venture partners, the Teachers Retirement System at Texas, Government of Singapore Investments Corp, and Pacific Life purchased the homes for $753 million, with financing coming from Bank of America. As of year-end 2021, the joint venture had a portfolio of 3,686 homes, the majority of which are being included in the upcoming securitization. The homes are part of a targeted goal of acquiring $5 billion in properties. So that's very interesting, right? When you start understanding how these things work. I haven't been working as much this year, but what I have been doing is watching 3 hours of YouTube a day, reading books. I read 6 different books listened to 6 different books this last month. This is a good time to really focus in on what is going on and study this stuff. You have to study these things. You can't just jump in. You can, but you have to be a student of the game and understand and learn these things. So a couple of good books that I've listened to. One was Dark Pools. I'm listening to that right now. Another one was 4,000 Weeks. That was one recommended by Brandon Turner. The Greatest Trade Ever was really good. Crash of the Titans. There's a lot of different ones that I've listened to over the years of how this works. So the book, The Greatest Trade Ever, was basically about this guy that made $4 billion shorting the housing market in 2008. So it wasn't the guy from The Big Short. It was a different guy. And he made the most money out of anybody. So understanding what is going on is very important. The interesting thing about that book is when he was trying to short the housing market, he got in a little early. Like if you watch the movie The Big Short, like Michael Berry did, this guy had more, and he just kept going. And he didn't understand housing, but everybody was saying, you're crazy, the housing market is strong. 2005, you're crazy. 2006, you're wrong. 2007, they still were saying you were wrong. There's a few people getting more into it at that point. But then the housing market started going down. 2008 started happening, and he started making a ton of money. So then what people were saying, you're crazy, sell out of your position. You made all this money, sell out of your position. Don't listen to the masses. Everybody's saying the same thing. Market won't go down because there's not enough supply. That's the same talking point from everybody. Well, you got to dive further, right? You have to understand that black swan events, which are events that crash markets that are unforeseen, you don't know what they are. You don't know what they're going to be. It's just how it works. Like if you learn about the stock market crash of 87, that Black Monday, learn about the flash crash of 2010 when the market corrected, because some computers were doing stupid stuff. You have to understand that you don't come to work one day and be like, oh, today's the day the housing market's going to crash, right? That's not how it works. I mean, I wish it worked that way because you'd make a ton of money. But so you have to understand this, and you have to understand your area. You have to understand the product. You have to pay attention to the numbers. I'm in the numbers. I'm in CoStar almost every other day looking at numbers. I'm reading articles. I'm on Redfin Data Center looking at what the market's doing. You can start to see trends. You have to protect yourself in this moment. But don't get scared. Keep pushing as much as you can, because if other people are saying, oh, the market's going to crash, I'm taking a step back, well, all of a sudden then your competition, there's going to be less and less competition. So then you find those really, really good deals that have a ton of margin in them. So that's what you should be looking at. So here's the other thing that scares me a little bit about the hedge fund stuff. There's an article that about, what was it? So here we go. Saw this the other day. This is crazy. Jeff Bezos-backed real estate investment platform fully funds 6 properties in under 12 hours. So, new offering. Vinovest lets you ride out market volatility with fine wine, blah, blah, blah. That's different. So, the real estate investment platform Arrived Homes launched its latest batch of new offerings yesterday. 6 rental properties that retail investors can buy into with as little as $100. The offering went live on the platform at 11 a.m. on April 5th, and all properties were fully funded in less than 12 hours. So we'll go down a little bit more. The property was acquired by Arrived Homes for $280,000, and investors purchased the 12,317 available shares at $10 each. So what they're doing is they're going and buying these homes, probably overpaying for them. Like all these hedge funds are overpaying for these things. It's crazy. Same as the mortgages, right? They don't care. They don't care what they're buying. They don't care who they're selling that stuff to. It doesn't matter to them because they know that they're not going to be left holding the bag, right? So then what do? They sell 12,317 shares at $10 each for the property. So, you see these, it's like going against the retail investors, right? From the Reddit community. So, hey, you want to get in real estate investing, but you only have $100? Here, buy 10 shares of this house. And then when they sell it, we'll get it back and you get a little bit of cash flow. It's freaking nuts. Like, how is this not scream like this is stupid? So there's so many stories like this. It's unbelievable. I mean, we worked with a company they're really good to work with, and they're growing really quickly. They raised a bunch of money, but they didn't understand, as well as most of you listen to the show, how to buy houses off market. And so they were buying stuff from wholesalers. They were buying stuff from us. They were trying to do this. It was a challenge for them to buy homes off market because it just takes a different skill set. It's not, unless you're the guy that's going to overpay and pay more than everybody else, it's really hard to win at this game. You have to have a skill set that understands sellers. You have to understand your market. You have to understand little different things about houses and streets and all these things. It's not as easy as people think it is. So that's my concern with hedge funds, right? So these guys are all pouring money into it. I think, okay, something's not right. So inflation. I'll touch quickly on this because I think this has been beat really hard. Just be careful. I went and bought windows, ordered windows for this flip 2 days ago. And I haven't ordered windows for like 2 years. So my gauge was way off. The guy came in at like $3,300 to install the windows. There was like 20 of them, which I was like, okay, that seems reasonable. And I'm thinking the windows are going to cost like $3,500 to $4,000. $9,100, even after my huge discount at Lowe's. $9,100. It should have been like $13,000 or something like that. I couldn't believe it. Like, it is unbelievable how much more things cost. So you have to be careful. The other thing that one of my buddies, Greg, as we talked about earlier in the show, that we're partners with, he has 40, 50 homes in the pipeline to build out. Their construction, community there, and the construction board, or whatever you call it, like it's the Home Builders Association in Kirkland and Seattle, they have estimated that prices will run up 20% this year on all material costs. Permit costs are up. Permits are delayed. All these things are crushing the costs of these houses. So you have to plan for that. You have to bake in 20%, let's say, more money if you're going to be building this out all year. If it's 6 months, maybe plan 10%, right? Plus a little buffer. You have to pay attention to these things. I think people think, oh, it's a supply shortage. All these things aren't here. The articles that I've read is the ports are getting through all the inventory. The warehouses are loaded. People have been ordering a ton of stuff. Here's the difference, though. They've been making record profits because people are paying it. Same with gas right now. The reason that's not going down is because people are paying the prices. Their job is to make money, right, wrong, or indifferent. A company's job is to make money and the most amount of money. Prices don't go down. If somebody's buying your service and or product or service, are you going to lower the price because you're making too much money? No. If you sell a house and you get like all these offers over asking, are you going to be like, no, I don't think I want that. Let's just sell it for the list price. No, never in a million years are you going to do it. So unless you have to, unless you list that house at that list price and nobody's making any offers and you get an offer that's 10% less and that's the only one, well, you might have to lower your price. So until that happens, prices won't go down. And just as all the oil companies are saying, even if the oil was $200 a barrel, they wouldn't try to increase the supply because why would they? They're making record profits. If they have to increase the supply, that means they have to go do more drilling. They have to go open up more sites. It costs more money, all these different things. Why would they? Why would they do that? They wouldn't. So gas is not going to go down, I don't think. Sure, it could go down, some, but until we get somebody in there that's not Biden, and this is not political, he talks about having 9,000 open permits, but I watched a deal about how just because they have 9,000 open permits from the federal government doesn't mean the environmental agencies have signed off on their permits. So it's kind of a word game, right? So that's the interesting part is they say there's permits already, but then their environmental people or the EPA or whatever say, oh, there's a wetland here, or there's this thing, we don't, they're protecting the environment, or the Native Americans, or all these different things. Again, I have no opinion on, whether they approve it or don't, but that's the case is they're not really approved. They can't just go there tomorrow and start drilling. So don't expect these things to drop anytime soon. So that's kind of my thoughts. I'd love to hear what your thoughts are. If you want to shoot me a message on Instagram, I'd love to hear it. You can shoot me an audio message. I love listening to that stuff. I'll respond. I love hearing different points of view. If you see any articles, I'm reading a ton of stuff right now. As I said, I'm kind of taking, the next 6 months to work on myself, but I also enjoy reading and learning these things so I can get stuck in the rabbit trail for months and months and months. So, anyway, hope you guys enjoyed the show. I think there's a lot of positive in this world right now. There's a lot of good things. I think it's just a time to make sure your business is in order. If you have systems and processes that you've been saying and procedures that you've been saying for the last year that you need to put in place and implement, you need to do those now. Just make sure your money's lined up with your private lenders. Make sure you have all these things prepared for things to go poorly. Not saying they will, but you need to be prepared for that. What is the saying? You got a plan to fail, right? So, and you write contracts with the best intentions, but you write contracts for when shit goes south. So anyway, that's what I got, guys. Hope you enjoyed it. My guy's not editing this that much today, so I apologize if there's any gaps in there, but I had to get a show out kind of quick, and I was putting this off because I wanted to make sure I was doing a lot of research. Couple sites that you should go check out and you should be paying attention to. Black Knight Mortgage Data is a very good thing for mortgage data. They have a huge report on like forbearances and stuff in different markets. Freddie Mac, I would go there. And then if you can get CoStar articles, they have a lot of good stuff. Redfin Data Center is really good for most markets. You can really play with it. It comes out, the updated stuff comes out middle of the month, and you can really see what the market's doing. It's got all the information. If you don't have access to the MLS, even if you do have access, I think this is better because it's on a graph. You can change the timeline. Understand inventory counts. You want to find out how many new home starts are in the pipeline. Understand where the inventory is coming, when it's coming online, and understanding those things is going to be very helpful for you. And so anyway, that's what I got, guys. Hope you have a great day, and I'll talk to you soon.